So, understanding 2016 tax benefits and credits. I'll be moderating, but this will be just about the last you'll hear from me until the end of the workshop. Jan Robson, I'm the Provincial Education Coordinator at the Alzheimer Society. And our presenters today are Kay Gray, and she's a partner with Grant Thornton Consulting in Vancouver. And I really want to pass along a huge thank you to Kay. Not only is she doing the tele-workshop today, but she was instrumental in getting our guide to benefits and credits organized. We have it on our website. We also have it as a download in this workshop. And that's a significant time investment, so it's certainly much appreciated. And Scott Kennedy, who is also from Grant Thornton, will be co-presenting with Kay. Now, Kay is a chartered professional accountant. She's worked exclusively in providing tax services for almost 25 years. She is, as I mentioned, a partner with Grant Thornton Consulting, a member of Grant Thornton Canada, and she works from the Vancouver office. Scott is a graduate of Kwantlen University and is currently studying to become a chartered professional accountant. He's a member of the tax group at Grant Thornton. So we have a wealth of expertise at our fingertips here today, and I am going to pass it along so that you can benefit from it.
And thank you for that warm introduction. Hello, everyone. Jan was a bit too generous. I actually owe a lot of credit to my colleague Scott for the updates for our tax guide this year. He did the lion's share of the work, and I thank him a lot for doing that. So today we're going to talk about the tax system and the tax credits which are available to individuals living in Canada. And we're going to have a quick overview of our personal tax system. I think that will help everyone kind of understand a bit more about how the tax credits work. And then we're going to review selected income tax amounts and credits. We've got a couple of examples, which we call scenarios, near the end. And then hopefully there'll be enough time for everyone if you have questions before we wrap up. So Jan, I think you want me to advance the slides, so I'm going to do that. So I'll start with a quick overview of Canada's personal tax system. And Canada's tax system can be complicated, particularly where personal tax credits are involved. So to help understand how the tax credits can benefit you, I would like to take a few minutes to just go over how this works. First, an individual taxpayer is subject to progressive tax rates. What that means is that as your income rises, so does the rate of tax applicable on the next dollar of income. So that means that the first, let's say, pick a number, $20,000 of income is taxed at the same rate for everyone in Canada. But if you earn $1 over that, you might be paying a different rate of tax on that additional dollar. Second, don't confuse deductions with credits. Deductions are amounts which are applied to reduce your income. Credits are applied to reduce your tax. So we're talking today about tax credits, and so specifically these are amounts that can reduce your tax. So I've got some examples here. One is that if you have gross tax calculated on your income of about $10,600, and then you have a tax credit of $10,000, that will reduce your tax owing to $600. And if you have less gross tax than you have credits available, then your credits might be wasted. And to avoid wasting, it's important to understand that some tax credits can be transferred. There's certain types of credits that can be carried forward. We're not going to talk about those today, but we will talk about some of the ones that can be transferred. The disability tax credit is a good example of that one. The other point about tax credits is that most are non-refundable. If you don't use them, they're gone for good. Most tax credits are eligible to reduce both federal tax and BC tax. You see, our tax system is really comprised of two types of tax, a federal income tax and a provincial income tax. It may not seem that way because the Canada Revenue Agency collects the tax on behalf of the provinces, or at least on behalf of BC it does. But it is actually two components. And each province sets their own tax credits. In many cases, the provincial tax credit is similar to the federal tax credit, but not in every case, and we'll be covering some of those. The other thing to note is that the maximum federal tax credit is 15% of the federal amount. Now, the one exception to that is donation credits, which I'm not going to talk about today, but for all other ones, it's 15%. And the BC tax credit is 5.06% of the BC amount. So you may recognize that these percentages are the lowest marginal tax rates as well. So my next slide, for those of you following along online, is basically a calculation of how a tax credit system works. So I'm going to use the basic personal amount for the example because all taxpayers in Canada, every individual taxpayer, regardless of age, income, or marital status, is entitled to the basic personal amount. So the federal basic personal amount for 2016 is $11,474. Now BC also offers this as a tax credit, but their amount is different. They haven't kept up with the federal government, so their amount has lagged a little bit, and it is currently sitting at $10,027. To arrive at the tax credit, you take your amount, and I'll use the federal one as the example, of $11,474, and you multiply it by the rate of 15%. And that gets you the tax credit amount of $1,721. And then for BC, the tax credit works out to $507. So on a combined basis, the total tax credit for the basic personal amount works out to $2,228. Now this is just for 2016. Amounts are indexed every year and will go up slightly every year, so every year they change, but this, the change is not that significant. So for example, a BC resident individual with $50,000 of taxable income would have $10,600 of gross federal and BC tax, but would only have tax payable of $8,372 due to the application of the tax credit for the basic personal amount. They may have other tax credits as well that reduce their tax payable, but just if we had only that one, that would be the net result. So the amounts and credits that we're going to describe in the following slides are just a few of the available credits. We selected these amounts as being commonly available to persons with disabilities or to the family caregivers or supporting persons of persons with disabilities. Each tax credit has its own set of criteria which are necessary to be satisfied in order to qualify for them, and we'll cover those criteria as best we can. So the first tax credit we're going to cover is the spouse or common law partner amount, and this credit is available to an individual that supported a spouse or common law partner during the year. So when they use the word supported, That's a key that you need to be aware that this is likely an income-tested credit. Because in this case, for tax purposes, they're considered to support somebody if that other person's income is very low. So for this tax credit, the federal tax credit is available if the spouse's or common law partner's net income was less than $11,474, and the BC tax credit is available if their net income was less than $9,445. So you'll probably recognize those amounts as being the same amounts as for the basic personal credit, and that's exactly right. They're saying that where you support a spouse or a common law partner, they don't get to claim their basic personal amount because they don't have enough income, so the supporting person gets to claim that tax credit as well.
Okay, I'm just going to break in here for 1 minute and apologize for the formatting problems that happened when these PowerPoints were put onto the Momentum website. So if, for those of you that are going to be downloading the slides afterwards, they are in a PDF format, so all of the information will be on there. I should have checked this before we actually presented. So my apologies to you, Kay. These mistakes are not Kay's. And to those of you that are trying to figure out what the heck's going on with these charts. Sorry about that.
Thank you, Jan. I was just wondering about that myself, whether it was just my screen. Okay. I just want to have a quick note as to who is considered to be a spouse or a common law partner for purposes of income tax. A spouse actually is really very straightforward. It is a person to whom an individual is legally married. And so for purposes of your tax credits, you can only have one spouse because our laws require you're only legally married to one person at a time. Now, there are other things in the Income Tax Act which extend the definition of a spouse to include former spouses. So this is not one of those. So if a former spouse would not qualify for the spouse or common law partner amount. Now, a common law partner is actually a different definition, and it is a person who cohabits in a conjugal relationship with the taxpayer throughout a 12-month period ending in the year. And so that's not a very long period of time, but there's also an exception to say that if the person and the individual are living separate and apart for more than 90 days within that 12-month period, that breaks the common law partner 12-month period up. And so for those individuals who are not legally married and are living in a common law relationship, and perhaps their partner has to go into a care facility or goes and lives somewhere else, this is something to be careful of because there is some debate now as to whether that common law partner relationship is continuing if that separation occurs for more than 90 days. So to determine if you're ever eligible to claim these amounts in respect of your spouse or common law partner, it's very helpful if you have the forms in front of you, the BC version of the T1 Income Tax and Benefit Guide, to look at Schedule 5. And that's the federal schedule that allows you to calculate your spouse's income and will tell you early on if you're able to claim some of these credits. Also, Schedule BC 428 is a schedule that will help you calculate the income for purposes of claiming the BC credits. And many of the income-tested credits are calculated on those schedules, and so they're very helpful to do those first if you're preparing a tax return for someone. So this is the point where I'm going to turn it over to my colleague, Scott, and ask him to go through the other specific credits that we're going to cover today. Over to you, Scott.
Well, thank you very much, Kate. So the first credit we're going to cover is the amount for an eligible dependent. This tax credit is available to an individual that supported an eligible dependent at any time during the year. It's really another personal amount for those who may not have a spouse or a common law partner, because you're not eligible to claim this if you do have a spouse or common law partner. You can claim this, though, however, for if you live with the dependent you supported in a home you maintain. So this may be your parent, a grandparent, child, a grandchild, or even a brother or sister who depends upon you due to a mental or physical impairment. However, if it's your parent or grandparent, they do not have to rely on you due to mental or physical impairment, as long as you support them. Wholly dependent, in this case, means that you support them by providing food, clothing, and shelter for the eligible dependent. However, you cannot claim this amount if the person was only visiting you during the year, or you're claiming the spouse or common law partner amount. As well, if someone else in your household is making this claim, you cannot make the claim as well. And you can also not claim the amount for infirm dependents age 18 or older for the same person that you're claiming amount for an eligible dependent. Now, it is an income-tested credit, similar to the spousal or common law amount, and it is it's the same cutoff level, $11,474 federally, or $9,445 in British Columbia. This is an amount that you would claim on Schedule 5 of your tax return.
Well, it's calculated on Schedule 5, and then it moves on to Schedule 1 of the tax return. Right. Thank you. Okay. On to the next one.
So the second credit that may be available to a lot of people is the amount for infirm dependents age 18 or older. This is available to an individual that supported a specified relative who is dependent upon them for support due to physical or mental impairment. One of the key differences between this and the last credit is the person does not need to live with you during the year. So an individual that you may support who is in a home or a care facility could qualify for this amount. They also must be resident of Canada still, however.
And you mentioned earlier, Scott, that this actually isn't limited to just one relative. You might claim this in respect of more than one relative,
Correct.
As long as they meet the definition. That's right. Okay.
This credit can also be split with another person. If you and a sibling are having to split costs, possibly for a parent in a care facility, both of you can claim an amount. You can split the credit. However, you cannot claim this amount if anyone is claiming the amount for an eligible dependent for this individual, or can claim the caregiver amount, which is a credit we're going to talk about later. And it is income tested once again at a slightly higher than the last credit, $13,595 federally, or $11,377 in British Columbia.
On to the next slide.
So the next credit is the disability amount. So this is a credit that's available to those who have a severe and prolonged impairment in their physical or mental function. This credit can be first claimed by the individual who has the disability, and then possibly amounts can be transferred to another individual, such as a spouse or a child or a parent. For impairment, it has to be prolonged, so it has to be 12 months or greater, and it must affect you at least 90% of the time. They're very specific on this credit of certain mental and physical functions that qualify for it, and there is a very useful tax guide that comes along with the form to give you guidance upon which mental and physical functions would qualify. Many Alzheimer and dementia patients will probably qualify for this amount.
But your doctor or another qualified practitioner must sign this form, and it must be submitted to Canada Revenue Agency as well.
Yeah. Depending on the type of mental or physical infirmity, the government has outlined which type of qualified medical practitioner can certify the disability,
Right.
and you have to pay close attention to ensure that it's certified by the correct individual. Once approved for the disability tax credit, individuals will be given a specified time period in which they won't have to reapply. So it may be applicable for several years, at which point you don't have to reapply every year. Once you have the credit on file, you can use it the next year as well. And then
I don't think it's income tested. That's one difference with this. Even if you made $1 million, you'd still be eligible for the disability tax credit.
yes, correct. Yeah. And if the doctor charges you a fee for filling out these forms, doctors charge fees for everything nowadays, those fees can be claimed as a eligible medical expense.
Excellent. Okay. Should I go on to the next one now? Okay.
So the next credit we have is the caregiver amount. So this credit's available to those who have a parent or grandparent who they possibly support and they live with you, or you have a brother, sister, or other specified relative who lives with you and depends on you due to mental or physical impairment. The dependent must be over 18 years of age, and they must be a resident of Canada, except if it's your child or grandchild. It has a higher net income cutoff point than some of the other credits, so it may be available to more people than some of the earlier credits.
Mm-hmm. So it's not showing up on the screen, so my notes tell me that the net income has to be under $20,607 for federal purposes. And so that is quite a bit higher than the other income tested amount.
One of the other things with this form, or this amount, is that you don't require medical certification that they have the impairment. So the level of disability is probably less than the disability amount. More people will qualify for this caregiver amount.
But if you actually have your parents or grandparents and they're over 65, they automatically qualify.
Yeah.
They don't even have to have an impairment at that point. Okay. I'll move to the next one.
The next amount we have is the family caregiver amount. This is really a bump up of other tax credits. So if you have a dependent who has an impairment in mental or physical functions, the amount that you claim for the spouse or common law partner amount, or the amount for eligible dependent or caregiver amount, gets bumped up an additional $2,100. So it's just something that we put on Schedule 5, that the person that I'm claiming my spousal amount for, they have a mental or physical disability or function impairment, and you get the additional amount on that.
Okay. So just to put it in some context, if I had a parent living with me in my home, and that parent had income under $20,000 and was over 65 years old, I could get the caregiver amount as the owner of the home, right? And then if that parent also had a mental or physical impairment, but not necessarily a disability tax credit level, but actually any mental or physical impairment, and then I would qualify for an increased amount in my credit. That's right?
Yeah.
Okay. And I think in this case, even though you don't need to submit a disability tax credit, CRA will or often ask for a signed statement from a medical practitioner just certifying what the impairment is and when it started. And I think you mentioned earlier, Scott, that this is important because it doesn't have to be a 12-month duration of this impairment. It could be a shorter period.
Correct.
And it would still qualify. Okay. I'll move to the next one now.
So the next credit we're going to talk about is medical expenses. Many of you may be familiar with this. You may be able to claim a non-refundable tax credit for medical expenses incurred on behalf of yourself, your spouse, or common law partner, and by specified relatives who are dependent upon you for support during the year. So if you have a parent or a spouse that you may be paying their medical expenses for, you have to be the one paying the expenses, but you can claim them on your own tax return. The limit during the year is limited by your income level or a maximum of $2,237 set by the federal government every year. There's many different expenses that are actually considered medical expenses. Walking aids and wheelchairs, prescription medications, hearing aids, dentures and dental services, personalized therapy plan for mental or physical impairment, recreational therapists and occupational therapists. Many different costs that you may incur actually qualify as medical expenses. So really do double check the medical expense guide that the CRA puts out every year. It's quite expensive, and there's a lot of medical expenses you might not consider that you've incurred during the year.
Mm-hmm. And importantly, there's some that are routinely denied as well as medical expenses. And I understand those are a lot of herbal supplements and types of herbal or supplements that are acquired without a doctor's prescription.
Yeah, well, and going back to that, over-the-counter medication is not considered a eligible medical expense.
That's right. But again, this is like you said, the list is extensive and it's constantly being updated. So it is worth looking into every year to see if there's a change that might benefit you. And importantly, keep all your receipts. That's right. Without receipts, the claim can be denied. And a tip on that is that if you commonly obtain your prescription medication from the same pharmacy for the year, that pharmacy will often be able to provide you with a printed out statement summarizing all of the purchases for the year, and that you don't have to then add up all of the little flips. And that statement is acceptable by CRA because it comes from a third party. So again, another way of keeping your costs down and improving your time to get your tax return completed, do things like get statements from your pharmacy. Okay, I'll move on to the next slide now.
So the next is the same to the medical. It's a medical expense, and it's really relating to medical expenses for traveling. Many people may live in rural areas or on the island, and they have to travel quite a distance for the care that they need. So under certain circumstances, the government will allow you to claim transportation and travel expenses as eligible medical expenses. The conditions are that the medical services or substantially equivalent medical equivalent services were not available near your home. So you live in an area and you simply prefer to go to another doctor, traveling for that is not an eligible medical expense. But if the doctor or the service is not available in your area, then it can be. You also must take a reasonably direct traveling route. You can't make a pit stop for a vacation along the way. And it is reasonable for you to have traveled to get the medical services. Now, there's two different distances for which the government has different qualifying medical expenses. So if you travel at least 40 kilometers one way directly to get medical services, you can claim the public transportation expenses you paid, such as bus or a taxi or ferry. Those type of costs would be eligible medical expenses. If you had to travel at least 80 kilometers one way, you may be able to claim accommodation as well as meal and parking expenses in addition to your transportation expenses. It's realizing that you might need to stay overnight, that some meals are going to be incurred along the way, and those qualify as medical expenses. As well, many people may not be able to travel by themselves and require someone to go with them to help them get to the medical treatment. If the medical practitioner certifies that you are unable to travel by yourself, the cost of the attendant who travels with you can also be claimed as a medical expense.
And I'm sorry that I didn't confirm with this earlier. Can the attendant be a family member?
Yes.
Okay, good. So just to be clear, these expenses are first claimed by the person with the illness first?
The person who pays them.
Person who paid them. Thank
Yeah.
you. Okay, so that's important.
So another big expense that many people incur is attendant care, either in home or in a facility. It can be a little complicated, this area, as it does interfere with one other tax credit, the disability tax credit. So in general, you can claim the amounts that you spent on attendant care for you, your spouse, or a parent that you are supporting. To qualify for attendant care in your home, though, and be able to claim these, you must be eligible for the disability tax credit and have a written certification from a medical practitioner that states the services are necessary. If you want to have a home care attendant come into your house to provide for someone, simply get the doctor to certify that it's necessary and fill out the disability tax credit to see if you qualify. Now, one of the complications here is if you're claiming greater than $10,000 a year in full-time care expenses, the government isn't going to allow you to claim the disability credit as well. So it really comes down to how much you're incurring in attendant care costs. Because to claim both, you're going to be capped at $10,000 in attendant care costs. So, for example, if you have $15,000 in attendant care costs, and you qualified for the disability tax credit, you could either claim the $15,000 in attendant care costs as medical expenses and no disability tax credit, or you can claim the $10,000 in attendant care costs and the disability tax credit.
And I think you said earlier the cutoff point, or the break-even point, is somewhere between $15,000 and $16,000. Yeah. Okay.
For the costs that are incurred for someone in a home or a care facility, the care facility will provide a breakdown of eligible medical expenses and those that are not eligible. Certain expenses related to care in a facility are not actually eligible medical expenses, such as the cost of rent for the actual facility. But wages and that of the staff are certainly eligible medical expenses.
You've made a point here, Scott, that an attendant who is hired privately may also be considered to be an employee. And that brings along another set of issues, doesn't it?
Yeah.
Not really related to what we're talking to today, but I think it's important for people to recognize that an employer has certain obligations under the Income Tax Act with respect to employees, even if you don't really consider them your employee. You've got not only income tax withholdings and CPP and EI remittances. You have you have to provide them with a T4 slip at the end of the year. So there's things to learn there. And you may also have to consider workers' compensation premiums as well if you've got someone working in your home. So that's also a key issue that I think many people aren't aware of.
One other thing to mention on the attendant care is they can't be a family member. You can't be paying someone who's related to you to be the nurse, for example.
Okay. On to the next one.
So another credit we have is the refundable medical expense supplement. This is different than the medical expense credit. It's available to working individuals who have very low incomes, but also have significantly high medical expenses during the year. You must earn income of at least $3,400
From employment.
From employment,
Yes.
Correct.
Yeah.
And your medical expenses tax credit is 25% of the medical expenses that qualify for the medical expense tax credit.
Okay, so just so that I understand this a bit more, if I was working and I had at least $3,465 of employment income, but I had $20,000 of medical expenses, I may, depending upon my income, be eligible for a refund, a tax refund of up to 25% of that, so $2,500 cash back or reduction of tax. Okay. But I note here that that kind of benefit goes away the higher my income gets. Okay, so it's reduced, I see, by 5% of combined family income over $26,277.
Yeah.
Okay.
It's really designed for sort of working poor people who have very high medical expenses during the year.
Good.
So, a brand new credit the federal government introduced just this year is the Home Accessibility Tax Credit. So you can claim this amount if you own a home in Canada and paid for eligible renovations to improve the safety or accessibility of your home. Many people do this if they're taking in their parent or a grandparent. They need to make slight renovations to the home to make it safer for them. Those type of expenses are the expenses that this is designed for. So to qualify for this, the person that you're making these improvements for must be 65 years of age or older, or eligible for the disability tax credit. So if they're below 65 and they qualify for the disability tax credit, you can claim these amounts. The home also must be their main residence. If your parent is merely visiting you, improvements you made to your house do not qualify. But if they're staying in a suite that you've possibly renovated or you've made wheelchair accessible, those type of expenses do. The renovations must be permanent and allow the individual to access the home or be more mobile or functional within the home. Or the renovations must reduce the risk of harm within the home or in accessing the home. Up to $10,000 a year and expenses are eligible. And you must keep documentation such as invoices, receipts. The government has put out a fairly extensive list of types of home improvements that would qualify for this amount in the medical expense credit guide. As well as in the T1 guide this year, they have a description of it.
$10,000 isn't very much, is it? But might as well use it if you can. Okay, on to the next slide.
So the last credit was a federal credit. Additionally, the provincial government has a similar credit, the BC Home Renovation Tax Credits for Seniors and Persons with Disabilities. They've made slight changes to the credit this year. Previously, it was only eligible, you had to be 65 years or older, the person that the renovations were being made for. But now, the qualifying person they're also qualified if they have the disability tax. So, very similar to the federal one, you can claim eligible expenses for certain permanent home renovations that improve access, mobility, or reduce the risk within the home. And you must be a BC resident and a senior or a family member living with a senior. So if you have a parent in your household over 65 and you've made renovations to the home, you can please qualify. So the maximum credit during the year is $1,000 based on 10% of the maximum $10,000 in eligible expenses. Some possible eligible expenses are grab bars and handrails in the bathroom to make it more accessible, wheelchair ramps, lifts, elevators, walk-in bathtubs. There is an extensive list of these. The credit can also be split among family members within the home. So a husband and wife have someone in their household that they've made these renovations for, they could split the credit amongst themselves.
Mm-hmm. So I also see that it's important that all of the documentation in respect of the renovations is retained. And that it's really important if you're using a contractor or a family member that person must be registered for GST and have a GST number on their receipt in order for it to qualify. Move to the next slide.
So this isn't a tax credit per se, it's just a little discussion in regards to certain goods and services that are GST and HST exempt and you should be aware of this when making purchases to ensure that you're not being charged GST or HST on them. If you do pay these expenses, you can qualify for a refund. Some of the examples of these are home care services, such as cleaning and meal preparation, shouldn't be being charged GST. Personal care assistance, such as assistance with bathing, feeding, dressing, taking medication, provided to you in your place of residence. Care and supervision services, home-delivered meals through certain programs, and certain medical devices and supplies. So if you have been charged this by a supplier who's charged you in error, you can, if you retain your proof of purchase, you can fill out a form for an application for a rebate of the GST or HST you paid on this amount.
Well, thank you, Scott. That concludes the list of tax credits that we wanted to cover. And what we thought now might be helpful is if we actually went through a couple of scenarios and talked about which tax credits our fictional people might be eligible for. And so looking at example 1, and I must say this is fictional. There's absolutely no one that this is based on. We're going to start with a fictional person, Mary, who's separated from her partner and her children are grown and moved away from home. So what we take from that is Mary is living alone in her home. Mary's mother, Janet, has Alzheimer's disease and has recently moved in with Mary. To make her home safer and more accessible for her mother, Mary has made some home renovations. She spent $4,000 for those necessary upgrades. Janet also has significant medical expenses, which Mary has paid for. Those included non-reimbursed cost of prescriptions, a new wheelchair, and eyeglasses, totaling $3,500. Mary has also paid for a nurse to come to the home to care for Janet several days a week. In 2016, Mary paid $8,000 for this. Janet's taxable income for 2016 was $30,000. She was over 65 years of age, and she was eligible for the disability tax credit. So Scott, what should Mary and Janet be aware of when filing their tax returns for 2016?
So,
Slide. There we go. Thank you.
so the first possible credit that Mary can apply for is the amount for eligible dependent. She does not have a spouse or common law partner that she's supporting in the household. So her mother can be considered an eligible dependent, and she would also get the family care amount bump up. The next amount she would qualify for is a caregiver amount. She is supporting her mother in her household, and this amount also comes with the family caregiver amount bump up.
But let me stop you right there. Part of the facts we said was that Janet's income was $30,000. So I think we said, oops, Janet has too much income for the bump up. Wasn't that, I just want to make sure that we're clear here. Wasn't that right? There was, the cutoff is about $24,000? Yeah. That's right. So that was, I inserted that to trip Scott up. So my apologies to Scott, but the point here being is that the amount for eligible dependents and the family caregiver amount are probably going to be denied because Janet has too much income. You'd think $30,000 isn't that much income, but in this case, it's over the threshold amount. But working through Schedule 5 and BC 428, you would have come to that conclusion by doing the math. Is that right? But at the same rate, these are the right things to think about. Yeah. Okay, so sorry for that. On to the medical expenses.
So Mary has paid for the expenses for her mother, So therefore, the $3,500 for eyeglasses and wheelchair and prescription, Mary's going to be able to claim on her own medical eligible expenses. As well, the $4,000 in home renovations can be claimed as medical expenses as well.
Oh, so you do get double that one. Oh, that's interesting. So just to be clear, medical expense claim is $4,000 for her home renovations, plus $3,500 for the wheelchair, prescriptions that weren't reimbursed, and eyeglasses, plus $8,000 for the nurse. And then she gets an additional home accessibility tax credit for the $4,000.
For the $4,000.
Okay. Got it. Oh.
As well, the disability amount, first it needs to be claimed on Janet's own return, and if there's any remaining credit, that could be transferred over to Mary. At $30,000, there's probably not going to be an amount to transfer over.
I actually prepared a tax return for Janet with $30,000 of income. I put on some Canada pension plan, her old age security, and a little bit of interest income that added up to $30,000. And that created tax payable for Janet. And with her disability tax credit, she still had some tax owing at the end. There wasn't enough of a tax credit there to wipe it out entirely. So there was no amount left to transfer to Mary.
The next one to consider would possibly be the refundable medical expense supplement. This is one that, without knowing Mary's income level year, we aren't sure if it will be eliminated fully, but it's something to consider when doing the tax return. As well, the BC home renovation tax credit for seniors. So those $4,000 in medical expenses, you're actually getting multiple credits on those home renovation improvements you made. You get the federal amount, you get the provincial tax credit, and you get to claim it on
your
medical expenses.
Which is both a federal and provincial as well. Interesting. Okay. Well, let's move on to our second example. And I'll read that. Jim is married. He still has 2 young children living at home with him. Jim and his sister Joan have determined that their father, Michael, who has advanced dementia, needed full-time care in a special care facility. For 2016, care at the facility cost $28,000 in total, $15,000 of which was deemed care costs, and I think what that means is it's eligible for a medical expense. Is that correct, Scott?
Yes.
Jim paid all of the cost himself. Michael, their father, also spent $1,800 on qualified medical expenses during 2016. Michael was over 65 and eligible for the disability tax credit. Scott, what kind of tax credits should Jim and Michael be considering when preparing their tax returns?
The first credit that comes into question is the amount for infirm dependents age 18 or older. Jim can claim this because he's supporting his father in a care facility. Even claiming the spousal amount, this is one that you can still claim. And as we mentioned earlier about the infirm dependents, they don't have to be living in your household. So because he's financially supporting his father in a care facility, he still qualifies for this credit.
Now on that point, we didn't give any information as to what Michael's net income was for 2016, but we would have to know that, wouldn't we, in order to be able to claim this credit or not, because these are income-tested amounts. Okay.
The next thing is the medical expenses of $15,000. These are eligible medical expenses. And here we run into the dilemma with the disability tax credit. So there's $15,000 in eligible medical expenses. And Michael's father, Jim, also qualifies for the disability tax credit. So we have the choice of claiming the full $15,000 in eligible medical expenses, or claiming $10,000 in eligible medical expenses, and Jim gets to claim the disability tax credit of around $7,800 or $8,000. So in this circumstance, it's going to be better to claim the disability tax credit and cap the medical expenses at $10,000.
That's right. But then if Michael had enough income, he would have to use the disability tax credit himself. Being the, no, Michael's the father. He's the one with the disability. So if Michael had income over a certain amount was taxable, he would first use the disability tax credit. But if he has very little income, that would be transferred to Jim, and then Jim would be able to make this decision.
Then the other one that could possibly come into play, once again, is the refundable medical expenses supplement. But once again, this one is very dependent upon income levels of both the father and son.
So given that Jim's got 2 young children, so he's likely got too much income in order to claim this, but still it's worth considering.